just a few little housekeeping things. The call is being recorded. As soon as the call is finished and encoded, I will upload it to the members area. That usually happens on the same day. Zoom has been very good to us lately with how fast they encode the calls. And then within 24 hours, we will add the timestamps as well. Please change your chat settings to everyone, just so we can all see your messages. I think everyone's on there. Fabrice and Diana are currently not on everyone. So if you could just change that. And when you do change it, you don't need to apologize to me. Zoom is weird sometimes. If you do want to come on live and ask a question, please just use the raise hand feature. I can unmute you and you can come on live. No problem at all. In fact, I welcome it. And I love to hear from everyone. So without further ado, please give a warm welcome to our new members. So Michael's here. Nilesh is here as well. So is there anyone else who joined in the last couple of days that's here? Trying to see. Yeah, so welcome everyone. I am so delighted to have you here. I hope we can, really help you with achieving all of those financial goals you have for yourself and really just progressing towards that financial freedom that we are all working towards. Okay, so a couple of disclosures before the call. Freeman Publications have active recommendations for the following stocks. That would be innovative industrial properties and realty income. And I am also long the following stocks in my personal portfolio. Segro, that is a UK-based REIT. For everyone in the UK, they're the people who own the Slough Trading Estate. Very sexy company. So we're going to be covering REITs today, real estate investment trusts. Jonathan says, ooh. I'm not going to lie, Segro has been a great performer the past couple of years. Such a boring company, but really, really solid. So yeah, stock market versus real estate. My view is, why not both? You don't have to get so dichotomous about it. I think REITs can play a part in everyone's portfolio. I think if you're looking to add income to the capital gain side of things, I think this is a no-brainer. There are certain advantages that REITs have in the way they are structured that make them solid income generators over time. And what I'm going to do in the next sort of 30 to 45 minutes or so is just discuss what it is we're looking for, what makes REITs so different, the different kinds of REITs that are available to us, and also just some of my own favorites. So sort of a top line look at it. If we're looking over the past 10 years, we're going to look at the Vanguard Real Estate ETF. So that's VNQ. And then the Vanguard S&P 500 ETF. That'll be VOO. So purely from a top line capital growth perspective, real estate's grown about half as much. However, it doesn't tell the whole story, because generally with REIT getting a lot higher dividends than you are with a regular stock. The average dividend for the S&P 500 is about 1.7%, which is extremely low on a historical basis. The average for a REIT, generally with REITs, we're looking at 4.5-ish and above as a sort of a benchmark for a dividend level we'd be happy with. And yeah, thank you, Greg, for adding the ticker symbols in. So REITs, and I've said it like 50 times now, but I thought I'd add it in already. It is pronounced REIT. It is not pronounced right. So it is a special class of company that allows you to get exposure to real estate without owning things like rental properties or a vacation property, or really having to do any sort of the work that comes with owning physical real estate. The other advantage is that REITs are more liquid than regular real estate investments because you can buy and sell them like you would a regular stock. And there are also many different kinds. So we have residential, we have commercial, so things like office buildings, hotels, healthcare properties, malls. And then we have the sort of industrial side of things, warehouses, data centers, self-storage, things like that. I am going to be talking a little bit about mortgage REITs later on in the call, but for now, I'm just going to hold off on those. So if they're a special class of company, you might be thinking, well, how does a company become a REIT? Why would a company choose to do that? So they need to meet specific requirements. And there are two, really. They need to earn at least 75% of their income from real estate. So the owning, the leasing of property. And the second one, which is very useful to us as investors, is that REITs must pay at least 90% of their taxable income out to shareholders. This is why we tend to get higher dividends, because the REIT is paying out more of its net income. And I want to just be very clear at the outset here. Net income is not the most important metric when it comes to looking at REITs. And I've had quite a few questions from people saying, hey, I've done a stock screener, for example, or I've looked at some REITs and their payout ratio is really high. And when it comes to traditional dividend investing, we want a low payout ratio. REITs work slightly differently, and I'm going to explain why that is later on in the call. But for now, just understand that paying out 90% of taxable income doesn't mean that these companies don't make any money. Greg says, REIT dividends are non-qualified tax at ordinary tax rate outside of tax advantaged accounts. Yes, that is true. I'm going to go into taxation implications for REITs at the very end of the call, just because I didn't want it to be like a distraction throughout like the sort of primer. But that is very true. And it's something you must understand as we're going through the process and as you're investing in REITs, if you choose to do so. So because of this, because of a company having this REIT status, they pay no corporate tax on their profits, which means REITs become very advantageous, I should say, if you have a tax advantage retirement account like an IRA, for example. I'll discuss more about that later on. But this is sort of where REITs are really, really useful, because we can stack that income in a tax advantaged way. So REITs have become very, very popular in the past 10 years or so. And there's a few reasons for this. They typically pay higher dividend yields than regular stocks. And you also get exposure to a new asset class. On top of that, there are certain tax advantages. So why do we love REITs as long-term investors? For me, really the first point I've made here is the number one. It's a source of reliable, growing income. The majority of REITs, especially the good ones, lease their properties on a longer term basis. So we're not talking your traditional sort of real estate investment where, say, you own like a single family property and you have one tenant and they can leave, you know, maybe with a month's notice. This isn't the kind of companies we're interested in. We're interested in companies that enter into 10-year leases or 15-year leases with their tenants. So we've now locked in that income, at least theoretically, for the next decade. So there is far less variance in quarter-to-quarter profits of a well-run REIT. Isn't that a tongue twister? Well-run REIT. Than there is for a standard stock, for example. And that's including like stocks that are generally thought of as stable. generally when we've looked at dividends in the past, we're looking at sectors like banking and financial, and also sort of the energy sector as well. REITs tend to be a lot more stable. And when it comes to your portfolio, they're a great way to get diversification. Goodness gracious me, I can't speak today. So here's really the big differentiator in the types of REITs that we have. We've got equity REITs. So these are the ones that own properties. So shopping malls, houses, regular residential property. And then we have mortgage REITs, also called mREITs. So you might see them written as mREITs sometimes. And I think it was Greg who asked me, are we going to be covering mREITs on this call? The answer is not really. I just wanted to make the distinction for people. These are companies that invest in mortgages, mortgage-backed securities, and other mortgage-related assets. The most important thing to sort of understand with mortgage REITs is that you need to look at them as financial stocks, not real estate stocks. Look at them more like a bank or an insurance company than you would a real estate company. I think that's a really important distinction to make, because sometimes, say you're running a screen and you see the word REIT, or in type of company, it's classified as a REIT, but it's actually a mortgage REIT, and it's completely different in its business model than, say, a REIT that owns shopping malls, or a REIT that owns what else are we talking? Senior housing. Jonathan says, any links whatsoever between mREITs and subprimes? Well, they're exposed to it because subprimes were mortgage-backed securities. And that was a big reason why everything went to pot, because, there was so much of this subprime stuff around, and these subprime mortgages were getting thrown in to these mortgage-backed securities with all the other non-subprime loans. And that's why everything blew up, because suddenly everyone's leverage was screwed and no one could pay anything back. And, this has given me an idea. Would anyone like a call in the future on sort of everything that happened in 2008, or really like 2007 to 2009, but sort of like an overview of the global financial crisis? Give me a 1 in the chat if that's something you would like. Because I have a story from that time that's very, very close to my heart. For those movie buffs among you, the movie Margin Call is probably, I don't want to say the best, because The Big Short is objectively a better movie. But in terms of everything that happened in 2008 in a sort of a real-time look, the movie Margin Call is fantastic. Although it's fictional, it is roughly based on what happened with Goldman Sachs and Lehman Brothers. So I'd recommend that. Oh, perfect. We're doing a 2008 call. And Greg makes a good point as well. He says mREITs involve underwriting considerations for the mortgages they hold. That's why I have on the screen, you need to look at them more like an insurance or a bank stock than you would a traditional real estate stock. Like, they can be very good businesses, don't get me wrong. But in terms of doing the analysis that we would do on an equity REIT, we can't do the same thing for a mortgage REIT. So from now on in this call, everything I'm going to be discussing is purely focused on equity REITs. Before I move forward, do people understand the distinction between the two? Give me a 1 for yes, 2 for no. Okay, good. I think I've covered this. And I understand that sometimes this is a little bit top line stuff and we're not getting too deep into the weeds. When we have calls like this, it tends to be more top line, unless we are going super deep into a specific topic, like we did it last week with the China stuff, or like we did with the fintech and crypto stuff before. Thank you, everyone. Thank you. Bradley and Eric, if you could just change your chat settings so I can see your wonderful answers. Okay. On this slide, I've highlighted 4 REITs. Who can tell me a potential issue in this graph? What is, if we were looking at these from a traditional dividend investing point of view, what would be a red flag that came up? Greg says EPS payout ratio. What specifically about the payout ratio is confusing or alarming here? Jose says payout ratios are high. Michael says crown up down. Greg says inappropriate for REITs. Very, very good. So payout ratio is a traditional dividend investing measure. It's simply the amount they're paying out related to net income. However, when you look at payout ratio for a REIT, you will often see that it's above 90% and it's above 100%, which for a traditional dividend stock would lead us to panic, because it literally means the company is paying out more than it's taking in, which usually signals a dividend cut is coming. However, for a REIT, payout ratio is a very misleading metric and one you should not rely on at all. So many equity REITs actually pay out more than 100%. This would usually be a huge red flag for a regular dividend stock, but payout ratio is a flawed way of looking at REITs. There is a much better and more accurate metric that we are going to use, and that is called funds from operations, or FFO for short. And Greg, I knew you were going to ask that. I knew. It's like whenever adjusted EBITDA comes up, you're always the first one to let me know. Don't worry, I'll get onto it. So funds from operations factors in depreciation, which is a key metric in real estate, because physical property rarely depreciates. It usually appreciates in value. So this is why when you're looking at funds from operations, they add back in the depreciation expense. Plus, they also make a few adjustments based on real estate as a business model, as opposed to a non-real estate business. This is why a REIT can have a taxable income of $1 per share, but a funds from operations of $2.50 per share. So them paying $1.50 in dividends is not uncommon, because even though that's 150% of taxable income, it's only 2/3 of funds from operations. So the company is still healthy, just it's a different basis of accounting. So when we're looking at REITs, we're always focused on funds from operations as opposed to payout ratio or earnings per share. In fact, we can even go further than this. And instead of looking at price to earnings, for example, we would look at price to FFO, which is a metric you can find if you look at these REIT websites. We are also trying to find a way to get into stock score. However, it's an annoying metric because data feeds don't usually carry it. So we may have to add it in manually ourselves. So that's the number one thing when you're looking at a REIT from a top line level and on a numerical basis. What is their payout when it comes to funds from operation? So if they're paying out $1.50 in dividends, but FFO is $2.50 per share, everything's fine. So what makes a good REIT? What is it we're really looking for? It's not too dissimilar to other stocks. We're looking for growth in FFO combined with growing payouts. And if we take this down a level, how is a REIT gonna grow its funds from operations? Well, it's pretty simple. They're going to charge more in rent. They're going to have higher occupancy rates. And depending on the type of REIT, acquire properties for a lower price. In British vernacular, do them up, improve them, then attract better tenants who are going to pay more and then get their overall rent levels up. And so when it comes to valuation, as I've already mentioned, price to FFO ratio and FFO per share are our North Star metrics when it comes to looking at REITs. And REITs are very nice to us. They understand what we're looking for as shareholders, and they understand what business they're in. So they will often report this as a headline figure, which leads me on to Greg's question. FFO or AFFO. So AFFO means adjusted. I looked into this over the past few days, and adjusted FFO is very interesting because it seems that each company has its own set of adjustments they make. So comparing them on a like-for-like basis can be quite tricky. You know, one company could have adjusted FFO of $3.50 per share. Another one could have it as $2.75 per share. But company A has just added in more things to get to that adjusted number, whereas company B hasn't. So it's not necessarily that company A is better or stronger. It's that we need to read the small print. And for those of you who are new, one of the things we keep hammering on again and again and again in this program is read the small print. Whenever you're looking at top level company information, like I'm going to show on the next slide, it's very helpful. If there's an asterisk, read what the asterisk is. And especially when it comes to anything with adjusted in front of it, we want to know what is being adjusted for. Greg, the real MVP. FFO as a standardized computation based on mREIT standards. Oh, you even mentioned mREIT as well. That's sort of like the I don't want to say the SEC for REITs, because that's sort of the wrong terminology, but it's a standardized oversight board. Would that be correct? Would that be a fair description of what they do? And yeah, you could do like for like comparisons. Adjusted funds from operation really depends on how the company computes it. So I did pull up a company, W.P Carey. I know a couple of you own W.P Carey. Give me a 1 in the chat if you do, because I've had a few members actually message me that they own W.P Carey. Really, really good company. We mentioned them in our dividend book. Bruce, good to see you, my friend. Sneaking in late. And the other thing for our newer members is if you sneak in late, I will still say hello to you. It's my superpower. So you see, this is W.P Carey's just second quarter press release. First thing they do is they talk about adjusted FFO. They say our guidance is this, and we're actually going to raise it. So pretty good. And then a couple of other key metrics here. Collection rate. So this is proportion of rent collected. W.P Carey, I don't know how they do this, but they're so good at it. Their rent collection rate is always obscenely high, especially when you compare them like for like to some of their competitors. 99% for Q2 2021. Even during COVID, their rent collection was something like 95% in Q2, when some of their competitors were in the 50s and 60s. Because obviously you know, if you're in the real estate business, especially say if you're in the shopping mall real estate business and everything's shut, you're not collecting any rent. And then they say occupancy. So this is another key metric. One thing we talk about a lot is key metrics for different industries. For REITs, key metrics right here: collection rate, or percentage of rent collected; portfolio occupancy, or the percentage of their overall portfolio that is actually rented to tenants right now. And I didn't highlight the one below, but I mentioned that at the start of the call. The average lease term. We want companies that have really long average leases, because it means for us as shareholders, less fluctuation in income. In an ideal world, all of these REITs would have 50-year leases at 100% occupancy, and they would be able to increase rent every single year. And just want to point something out here. You see here, they have annualized dividend rate. And I apologize if this font is too small, by the way. Annualized dividend rate of $4.20 per share. But you see here, adjusted FFO is between $4.94 and then $5.02 per share. So this is less, which means the company is in a healthy position. It's not paying out more than it's taking in. For us as shareholders, good sign. And Bruce says they buy buildings from businesses that want the money from the business they are occupying. I love W.P Carey. We spent a lot of time in our dividend book mentioning them. So if you guys haven't seen the dividend book, we did a write-up on W.P Carey in there. And just another thing, a good rule of thumb to have here. And I pointed this out when Jonathan shared Asana's Q2 report in the Facebook group. If a business is reporting a metric in an earnings press release, it's a pretty important metric to them. And there is one big caveat to this. That metric has to have direct correlation to dollar bottom line. And by that, this is what I mean. I'll give you an example. If a business says, say it's a software business, they say we had 1 million users last month. That was an increase of 50%. But then they don't tell you how many of those users actually paid any money. Not very useful to us. But going back to the Asana example, they said, hey, here's our revenue. Here's our percentage of revenue from companies paying more than $5,000 a year. Here's our percentage from companies paying more than $50,000 a year. And here's what each of those have increased by. Both directly related to the bottom line, key metrics that we want to monitor going forward. Same here. Adjusted funds from operation, direct correlation to the bottom line. Rent collected, direct correlation to the bottom line. And total portfolio occupancy, direct correlation to the bottom line of the business. Give me a 1 in the chat if that makes sense regarding key metrics specifically. We're always looking for ones that directly impact the company's bottom line. Because we don't care about vanity metrics. I don't care if they broke ground on a new project. That's nice. But I want to know how much money are we making. I want to know how many contracts were signed. I want to know how much money those contracts brought in. When it comes to REITs, I want to know percentage of rent collected. I want to know total occupancy, and I want to know that funds from operation number. Now the fun part, taxes. As a disclaimer, I am not a tax professional, nor do I claim to be. REITs are taxed differently to regular stocks. If you have multiple accounts, if you have investments over a completely different set of accounts, and you're under a absolute minefield of forms, pay the money, consult a tax attorney or a tax planner. It's well worth it. Some of the best money I've ever spent in life is to accountants and tax professionals, because they can save you a lot more than you're going to pay it legally. I should state we are fans of staying within the law here. So, tax implications of REITs. The caveat of the lack of corporate taxation, it means for us, it can be a little bit more complicated than just regular taxes on dividends or regular capital gains taxes. So I should have highlighted the word typically here, because not always the case. Once again, check with the professional. REIT dividends you receive will typically be taxed as ordinary income. Say that again. REIT dividends you receive will typically be taxed as ordinary income. Sam, that is a very good point. We have a specific REIT valuation sheet in week 5. And I show you in that sheet where to get funds from operation. And I also have a baseline metric of what is sort of the average price to FFO ratio for a REIT. I believe when I made the sheet, it was about 19-ish. If you own REITs or other real estate investments in a Roth IRA or other after-tax account, you don't get a tax deduction for your contributions, but you do get the same deferral of dividend and capital gains taxes. And then qualified withdrawals are tax-free. Once again, this is generalized advice. If you do need advice specific to you and your personal situation, please consult a tax professional. Anyone that deals with REITs regularly will be able to explain this to you quickly and promptly. And the other thing is, speak to your broker as well, because what may well happen is they will send you a bunch of different forms and they will help you understand what the forms are. So I cannot stress this enough. REITs are not taxed like regular dividend stocks. So it helps to, really get a professional opinion if you are planning to dedicate a significant portion of your portfolio, or if you have multiple investment accounts. Do we understand the difference between a REIT dividend and a regular stock dividend on like a top line level? Ordinary income versus like a standard dividend. Okay, fantastic. Yeah, Greg makes a really good point as well. Talk to professional, especially with regard to pass-through entities like REITs, BDCs, which we discussed briefly in our dividend call, and master limited partnerships as well, which you will see a lot in the energy sector. And the reason that, I like to bring these things up is that when you're doing especially if you rely a lot on stock screeners, say you screen for stocks with a dividend yield of above 6%, you're going to get a lot of REITs come up. You're going to get a lot of these BDCs, business development corporations, or MLPs, master limited partnerships. And if you don't understand the difference in business structure, then you are liable to put yourself at a disadvantage by not buying them in the right account. So that's why it pays to understand the differences between some of these companies. Because if you just rely on stock screeners, or you just rely on websites that list like best dividend stocks, you're doing yourself a disservice, because not all of these companies are created equal. So some of my favorite REITs. Actually, before I tell you mine, tell me some of yours. Let's have some REITs that people own. Stag. I love Stag. Amazon's landlord. Even though only a very small percentage of their total revenue comes from Amazon. IIPR, my all-time favorite. Stag and DEA. DEA still has the best ticker. They are winning the best ticker. Just because. DEA, man. We got Stag, we got Realty Income, Crown Castle. Oh, I love Crown Castle. Oh, I forgot to put Crown Castle in the disclosure. I am sorry. Crown Castle is another one of our active recommendations. So Crown Castle International, CCI. I do apologize for that one. That was a mishap on my part. American Tower as well. See, I like American Tower. It's just I chose Crown Castle because they had less China exposure. But I don't think you can go wrong with either of them, to be honest. DOC. What is DOC? I always blank on some of these ticker symbols. Physicians Realty Trust. Interesting. Could be one to look into, actually. SCI, another one. There are some really good REITs out there. And I encourage everyone, especially if you're more focused on income, to do some research into REITs. We do have a REIT investing book planned. It's still in the very early stages, so it won't be out this year. But the aim is Q1 of 2022 to get that one out, where we're going to dive into these in depth and really do a breakdown on like the different types of REITs you can own. Because I think a lot of investors sort of sell themselves short by only focusing on the sort of residential property type ones. Whereas I really like the industrial side. I really like companies like Innovative Industrial Properties, companies like Store Capital, companies like Digital Realty, for example, data centers. Data centers, genius. Give me some more data centers. Things like that. Businesses you wouldn't necessarily like think of first and foremost when you think real estate, but then you realize like just how massive some of these operations are. And for your portfolio, very, very healthy. So here's some of my favorites. Realty Income, W.P Carey, we've mentioned both of those. Innovative Industrial Properties, the all-time favorite REIT of mine. They, if you're unfamiliar with them, they lease land to marijuana growers. The stock has only gone one way over the past 5 years. Even since we recommended it back in June of 2020, it's up about 160% since then. Just really well-run business. They haven't got much competition, especially with the way that the marijuana industry is. Greg brings up a great point, and they provide funding for their clients because as a marijuana business, it's very difficult to get funding from traditional sources like banks. Stag Industrial. If you've ever seen any sort of sales pitches for newsletters with Amazon's landlord as one of the stocks they tease, that's the stock they're talking about, Stag Industrial. Store Capital. Berkshire have owned this for quite a long time. It's not a massive part of their portfolio, but they've owned it for a while. If anyone could in the chat could let me know how long they've owned it, that'd be useful. And for my European brethren, I don't want to leave you out. Segro is my favorite from the UK. They own industrial estates all around Europe. Really, really boring business. But hey, stock increases, nice healthy payout. And when you come out of Heathrow Airport, one of the first things you see is a big Segro sign. So it always makes me feel at home when I'm there. Okay. That just about ends the call presentation. So do we have any questions? Was that a useful overview on REITs and how they work? Yes. Well, wonderful. I am glad that I could help you with that, because they're an interesting concept, are these REITs. What I'm actually going to do is I'm actually going to show you going to jump into the course and show you where a couple of things are regarding REITs specifically, because Sam asked how you value them. So what I'm going to do is I'm just going to share my screen. I'm going to unshare my screen until I can log back in, because apparently one of the team has been in the account. So we are logged out temporarily. Okay, we're back. So if you go to week 5, the final lesson in week 5 is valuing a REIT. That is down there. So we have a separate valuation sheet. And we also have a separate video tutorial for that, where I show you how to get some of the metrics, like funds from operation per share, things like that. Okay. Couple of questions. Warning signs like SPG propping up JCPenney and other retailers, equity offerings, debt structuring. Warning signs, I would say, are not dissimilar to how we would look at a regular company. Is all of their income dependent on a single customer, for example? Big one. Don't want a company like that, because we saw what happened in 2020. SPG was a great example, to be honest. They own mall space, and we saw what happened there. And quite a lot of their income was from a select few customers. Things like societal shifts. So, like, for example, I'm staying away from malls. I really don't think there's much value to be had there. I would much rather focus on where the world is going. So for me, things like data centers are much more appealing. Things like industrial warehouses, because of the rise in e-commerce, much more appealing again. Other warning signs, trends in funds from operation, always a good one. One thing I really like doing is just monitoring percentage of rent paid, because that can be a really good early warning sign. And that tends to be a leading indicator rather than a lagging indicator. Sam says, on Physicians Realty Trust, self-managed healthcare real estate, acquires, manages, and owns healthcare properties leased to physicians, hospitals, healthcare delivery system. Did you copy and paste this from someone? It reads like a summary on a stock website. Nothing wrong if you did. Okay. But yeah, thank you. Thank you for sharing that with everyone. I appreciate that. I'm always interested in healthcare REITs. We had a big REIT purchase in the CEO buys a couple of weeks ago as well. SUI, I believe that was a ticker, Sun Communities. CEO did a $45 million buy, which is the second largest we've had in the past year after Asana. So those of you who are interested in REITs, could be well worth looking into that one, because I don't know too much about them myself. I took a brief look at the stock. It's only gone one way in the past sort of 3-4 years, and that's up. But good starting point. A large CEO purchase like that is always a good starting point. But yeah, I think we've got a couple of really good things to work off of from there. I'm going to do a little bit more look into this Physicians Realty Trust, because it seems interesting on the surface. Next week, we have a call on ETFs. So I'm going to be doing a breakdown of, this is going to be part 1 of 2 for ETFs, just because there's so much to cover. I won't have time to cover it all in a single call. But in part one, we're going to be focusing on, the rise of ETFs, why they've been so popular over the past decade, how they work on a sort of structural level, the different types of ETFs that are out there. And then we're really going to be taking a look at sort of index ETFs on that call. And then on a future call, we'll be looking more at the sort of thematic ETFs. Like, I've shared with some of you the semiconductor ETFs, the pet care ETFs, the marijuana ETFs. And then I'll also be discussing on next week's call sort of some warning signs and red flags to look at for ETFs, because it's very easy to get burned with them if you don't understand what you're buying. So I'll be covering some things like that. If anyone remembers what happens with USO, the oil ETF last year, I'll be using that as a case study for sort of what not to do. And the week after that, we will be doing another livestock deep dive. And next week, I'll tell you what the stock is, because I know some of you want to get a 2-week head start. I'll give you a 1-week head start. And Sam, I got your email. I will get to it. Don't worry. Like I said, it's been kind of a chaotic last week or so over at Freeman Towers. Anyone experienced with lending shares? Fidelity is offering interest rates as high as 25% for lending shares of stocks that are highly shorted. I've never done this myself. I'm always very hesitant with things like this. I want to know what happens if everything goes wrong. So whenever things like this come up, I'm always very skeptical and very hesitant. But if anyone does have experience, please feel free to chime in, because I know that people are looking for ways to make extra income. And this just happens to be one of them. I know I have a friend of mine who's big into like peer-to-peer lending, which is different from this, but he's a big fan of that stuff. Not something we've ever covered as part of this program, and kind of beyond the remit of what we're trying to do in this program. But if anyone does have experience with what Sam posted about, what I'll do is I'll put it in the lesson notes as well, so people watching the recording can see it. And if they have some experience, maybe they can offer their thoughts. Can you make the PowerPoint of each weekly call downloadable via the resource link? Yes, it's on the to-do list. I will get one of our team on that. And yeah, I just want to apologize again to everyone for, there's been a couple of things that, I've wanted to get done for the last couple of weeks, but we haven't been able to do. Like I said, we had some issues behind the scenes, but we are back to full manpower now. So we are full steam ahead again. And the email issue I posted about in the group earlier is already fixed. So don't worry. If you haven't ordered your books already, order your books. If you haven't added your bonus member yet, add your bonus member. What else? How big is your team? So we have me, 2 other full-timers, 4 contractors, and then we're bringing on a additional full-time person as well this month. We plan to bring on another one last month, but they turned us down to go and work at a hedge fund. So that's my reaction to that. Do you have a book on REITs? We have one in production. It should be ready Q1 of 2022. But we have one more book to release before that, which is the Moats book, which should be out by the end of this month. And yeah, then the REITs book is next on the list, because a lot of people have been asking for it. Surprising amount of demand for a REITs book. So don't worry, it's coming. And then we've got some more cool book projects in the pipeline. What I'm actually going to do for the next one after the REITs book is I'm going to let you guys vote for which book you want next. So what I'll do is I'll present some ideas of potential books, and I'm going to let the vote go to you lot. And the one that gets the most votes is the book we'll make. So Isn't that fun? You get to be part of the production process. Do you have a stock screener for REITs? Not offhand, just because I haven't really got one yet that I'm happy with. But we're working on it. Because like the dividend screener, for example, I was really happy with when I brought it up on the call, because I felt like it did bring up really good, fundamentally sound companies. The REITs one, I haven't got it to that level yet. When I do, we'll put it in the lesson notes here, and we'll put it in the group as well. Because I only ever want to bring stuff that is like top quality. Don't want to half-ass things, you know? I think that's a good philosophy to have in life. Do we have any other questions? Like I said, doesn't have to be about REITs, can be about anything really. And you're more than welcome to submit the questions before the call. Update on Stock Screener. It's live. It's live in StockScore now. Did I not say that last week? I hope I did. Yeah, the Freeman Moat Screener is live on StockScore now. Let me give a quick tutorial. Yeah, I think I did this because someone messaged me after the call about it. And they told me to look into a particular company. So let me just show you where it is on StockScore. So we have the idea generator here. Then we have the stock screener. So this is all companies that fit the Freeman Moat criteria. So there are 346 of them. So obviously you've got the big boys, but then you have some smaller companies as well. My goodness, this is fast. So we've got our friend Kinsale. National Beverage Corporation. Amanda, if you're watching the recording, I know you're a big National Beverage Corporation fan. Appfolio, that's another interesting one. I've looked into them as well. Anyone own Callaway? Anyone? Will you ever write on trading indexes? So we have done in our credit spread book and our Iron Condor book. Especially in the credit spread book, we talk a lot about trading indexes in there. So if you haven't, Eric, I don't believe you have ordered the books. Merger with Topgolf. God, that'd be cool. Question on FinViz. Do we have access to Elite? No, FinViz Elite is a separate thing that we don't have control over in terms of what we can give you access to. But we're essentially trying to build everything in FinViz into StockScore and give it to you for free. But in terms of do you have access to Elite? No, not as part of this program, no. It's a separate service and it's not something that we can control. Although the FinViz free version is pretty robust, I must say. It's much better than most of the other free stock screeners. And one thing I do like about FinViz is that their site isn't completely ruined with ads on the free version. There's some ads, but it's not unusable like Guru Focus is, or like Market Insider is. Sean says, sorry, I remembered that you said the server moved. No problem at all. Yeah, we moved the server, but everything, StockScore's live right now. We didn't have any downtime when we moved the server. So yeah, everything's live right now. Shouldn't be any issues. But yeah, as always, everyone, thank you for being here. Let me just read Bruce's comment. There's always one comment that comes in just before while I'm signing off, and I always feel terrible. that I don't address it. So I'm going to address it today. Stocks that dive that may be oversold would be a good subject, like Fiverr, Autodesk, and Sam are interested to me. Oversold stocks and how to recognize them. Give me a 1 in the chat if you want that as a future call. Okay, wow. Never seen so many ones. Oversold and short squeeze. Yes, absolutely. Okay. Duly noted. Wow. I think we now have enough topics to take us up to the end of October. But just between you and me, I'm thinking of adding in a second coaching call each week. Don't tell anyone. But we have to make some additions in order to bring in a second coaching call, because I love doing them. I know everyone here loves them, but we're having capacity issues in that there's too much to do. So things like adding in a second coaching call we want to do it, but we need to get more people in. But don't worry, everything else is coming, because I know there's another. Actually, no, I won't riff on the other investing companies. I won't do it. I'm a nice person. What can I say? But yeah, we are planning on adding in a second one, and hopefully we'll be able to do it at a time where the people who can't usually make these calls. So if you're watching the recording, if you can't usually make these calls, hopefully we'll be able to do it at a time to, have people who can't usually make the regular calls. Sam says, just an idea, have the member be a volunteer to do a weekly call. If anyone wants to volunteer, even if it's just doing it with me, I am more than happy to facilitate that. I would love to be able to do that. So if anyone, this is an open invite. If you want to come on and do a call with me to discuss like an area that's like really within your circle of competence that you think would bring value to the group, 1,000,000% we will do that. That is an open invitation. Because number one, beats looking at me all day. And number two, it's great to have other people's viewpoints. We have some seriously smart people in this group. I've had emails from people telling me about their big wins. And there's always a commonality there. It's areas that were very entrenched within their circle of competence. So if anyone wants to come on, send me an email. We will get it sorted. Bruce says, shipping problems in China are being resolved. Ethereum is going as a result. I hope so. I wouldn't go that, I wouldn't read that far into it at this point. I still think Ethereum has a lot of hurdles to overcome in the next few quarters, but things are definitely looking a lot better than they did a few weeks ago. I'll say that much. Okay. I'm going to try and sign off again. I hope everyone has a fantastic week. I will see you all at the same time next week. If you have any questions, send me an email in the Facebook group. I hope all of you stay safe, stay healthy, tell your family you love them, and yeah, see you all next week. Bye-bye, guys.